Hello, this is Japanese Economic Review Channel. This time, let's take a look at SBI Securities' domestic weekly outlook.
Yes, and we have a lot to get through today.
We really do. I mean, imagine you're navigating this massive commercial ship through really tense, contested waters, like the Strait of Hormuz, right?
Right.
At the exact same time, the currency you're using to buy fuel for that ship is just plummeting by multiple yen in a matter of hours.
Which is, frankly, terrifying.
Exactly. And to make matters even more complicated, your financial team, the people you rely on to hedge that risk, they're completely out of the office for a week-long national holiday.
Yeah, and for you listening, that is not some hypothetical scenario. That is the exact reality the Japanese market is facing right now.
It really is. So to make sense of this environment for our deep dive today, we have three strict pillars to unpack. First, we're going to break down this week's stock outlook, looking at the underlying resilience of the Japanese indices. Second, we're diving into the key focus materials and, honestly, the absolute roller coaster of the foreign exchange market.
The FX market has been wild.
Totally wild. And third, we're going to walk you through a day-by-day weekly timetable because the schedule this week is basically littered with traps for the unwary.
It's a minefield.
It is.
Yeah.
So let's start with the stock outlook. Just setting the baseline here.
Yeah.
We have the Nikkei 225 sitting at 59,716.18, which is down about 203.06 from the previous weekend.
Right.
But the TERP, interestingly, is sitting at 3,716.59. It's actually up 12.1.
Yeah, and that divergence between the Nikkei and the TOPIX, it tells a real story. We're in the middle of corporate earnings season, and investors are being highly selective.
Right.
But the broader takeaway from the SBI Securities outlook is really this overarching theme of structural resilience.
Yeah, the analogy that kept coming to mind for me while I was reading the source material is like a heavy-duty shock absorber.
Oh, that's a good way to put it.
Because when you list all the external hits the Japanese stock market has taken recently, it's staggering. I mean, we're seeing suspected yen buying interventions by the Bank of Japan. We have rocky peace negotiations between the U.S. and Iran really weighing on global sentiment.
Yeah.
And on top of all that, everyone was bracing for this massive wave of profit-taking on AI and semiconductor stocks.
Right. But the thing is, that anticipated tech sell-off, it's been surprisingly limited.
Really limited, actually.
Yeah, the market is absorbing these shocks without completely derailing the broader upward trend. So those shock absorbers are definitely doing their job.
Yeah.
However, and this is a big check, however, looking at the structural mechanics of next week's calendar reveals a pretty significant looming cliff.
Well, because of the Golden Week holidays, right?
Yeah.
This week only has 2 actual trading days in Japan.
Exactly. And crucially, Friday the 8th is Options SQ in Japan.
Okay, so SQ, that stands for special quotation.
Right, special quotation. It's the specific day when index options and futures contracts expire and settle. And just to briefly explain the plumbing of this for you guys, market makers and institutional investors who sell options, they have to constantly buy or sell the underlying stocks to hedge their risk.
Just to stay balanced.
Exactly. But on SQ Day, when those contracts officially expire, they are forced to mechanically unwind those hedges.
Oh, wow. So this generates massive trading volume that has absolutely nothing to do with fundamental valuations.
Nothing at all. It is purely mechanical buying and selling just to balance the books.
That's wild.
And furthermore, this Japanese SQ is followed by the major U.S. options expiry the very next week. So when you combine the forced mechanical trading volume of an SQ day with the fact that Japanese market participants will have literally been away from their desks for a week,
you have a classic recipe for sudden, completely unexplainable price volatility.
Precisely.
I want to push back on the fundamental valuation aspect for a second, though, specifically regarding the currency dynamic, because the outlook clearly notes the suspected intervention by the authorities. If the Bank of Japan and the Ministry of Finance are stepping in to deliberately make the yen stronger, isn't that historically terrible news for the Nikkei?
Absolutely.
Like, I'm trying to wrap my head around why the market would act like a shock absorber if its fundamental currency floor is actively shifting underneath it.
Well, you've just hit on the core tension in the market right now. You are entirely accurate about the historical dynamic. A stronger yen actively hurts the Nikkei.
Because of export revenue.
Exactly. Japanese heavyweights, the massive automakers and electronics manufacturers, they generate a huge portion of their revenue overseas in dollars dollars and euros.
Right.
So when the yen strengthens, the actual value of those overseas earnings shrinks the literal moment they repatriate that cash back to Japan.
So a stronger yen literally erodes their balance sheets.
It shrinks their profit margins.
Yeah.
And the timing makes this so much more critical because companies are currently setting their business forecasts for the brand new fiscal year. If they are forced to base their upcoming models on a stronger yen, it actively limits their potential for upward earnings revisions. It basically caps the optimism that typically drives stock prices higher.
Okay, so those shock absorbers are taking hits from both the tech sector unwinding and this currency tension.
Yeah.
And then we have to layer on the geopolitical headwinds, which the SBI report outlines in stark detail.
Yeah, and looking neutrally at the geopolitical landscape here, the headwinds are just acting as a constant drag on market sentiment.
Definitely.
The outlook highlights that the U.S. Trump administration's strategy in the Middle East appears to be struggling to gain traction.
Right. And Iran is, at least publicly, not showing any willingness to yield on the nuclear negotiations either.
Exactly. And going back to that scenario we opened with, this has direct physical implications for the Japanese economy.
Yeah, because Japanese commercial ships are actively having to navigate the Strait of Hormuz under these incredibly tense conditions.
And it's a critical global choke point. When that choke point is threatened, insurance premiums for shipping just skyrocket.
Right.
Supply chains risk severe disruption, and most importantly, it threatens the global energy supply.
Which is huge because Japan relies heavily on imported energy. So a spike in oil futures due to Middle East tensions acts as this massive, unavoidable tax on both Japanese corporations and consumers.
Right. They import the inflation without getting any of the economic benefits. If oil spikes significantly, the stock market's current optimism could just vanish overnight.
So factoring in all of this, the options see volatility, the yen intervention risks, the geopolitical tension, the outlook forecasts an incredibly wide range for the NEC yen next week.
Yeah, they're projecting a berth between 57,500 and 61,500 yen.
A 4,000 yen range perfectly reflects the uncertainty.
It's a massive gap. But that volatility in the equities market makes perfect sense when you look beneath the surface. The foundation of those corporate earnings, the actual value of the yen itself, is currently experiencing historic whiplash.
Which perfectly brings us to our second pillar, key focus materials and foreign exchange.
Yes.
The dollar-yen pair has been an absolute roller coaster. I want to walk you guys through a dramatic day-by-day recap of this currency market from late April to the start of May.
Because it truly reads like an economic thriller.
It really does. Let's start with the pressure cooker building on April 27th. Oil spikes, U.S. long-term yields rise, and the dollar is heavily bought against the yen.
And this is primarily driven by yield differentials. When U.S. interest rates stay high and Japanese rates stay near zero, global capital naturally flows to the U.S. dollar to capture those higher returns.
Right. Investors just abandon the yen.
Basically, yeah.
So that sets the stage for April 28th. The Bank of Japan holds their interest rates steady, but their accompanying messaging sounds incredibly hawkish.
Right, they signal they're getting serious about inflation.
Exactly. And the market reacts instantly. The yen is bought and the dollar briefly drops below 159, but the relief is momentary.
Super brief.
Because just 24 hours later, on April 29th, the U.S. Federal Reserve's FOMC holds their rates steady, and they also sound hawkish. They push back hard against the idea of cutting U.S. rates anytime soon.
Right, so the yield differential widens again, and the dollar blasts upward, breaking into the 160 range for the first time since early April.
Creating the conditions for the climax on April 30th.
The big day.
Suspected government and BOJ currency intervention hits the market. They step in with massive capital, and the dollar plummets from 160 all the way down to the mid-155 range in a flash.
Just an absolute vertical drop.
Followed by, honestly, psychological warfare on May 1st. Japan's vice finance minister Atsushi Mimura steps up to the microphones and gives a classic no comment regarding whether they actually intervened.
Yeah, the Ministry of Finance loves using ambiguity as a weapon. By refusing to confirm the intervention, they keep speculative short sellers totally guessing about when the next hammer might drop.
Right.
Consequently, the dollar crept back up slightly to the 157 range.
So the market literally goes from 159 to 160, crashing to 155, and settling at 157, all in the space of a few days.
Unprecedented volatility.
Looking ahead, the expected range for the upcoming week is pegged between 155.000000. But the glowing red warning light for anyone with market exposure is the liquidity drain of Golden Week.
Yes. The Japanese market participants are away. The liquidity pool in the Asian trading session is incredibly shallow right now.
Right.
We need to look at the actual plumbing of a thin market to understand the flash crash risk. In normal conditions, there are thousands of buyers and sellers to absorb a large order.
Right. There's always someone on the other side of the trade.
Exactly. But right now, if a hedge fund tests the waters or an unexpected headline drops, there simply aren't enough counterparties. The currency pair could gap up or down by multiple yen in seconds simply because the market structure is too thin to handle the volume.
Wow. So given that thin liquidity and how wild April 30th was, the natural question is whether we're going to see back-to-back interventions by the Japanese government.
Right.
Like, if the dollar starts creeping back to 159 while Tokyo is on vacation, do they pull the trigger again?
Well, looking at the analysis, continuous rapid-fire interventions are seen as pretty unlikely.
Oh, really?
Yeah, because the authorities have somewhat contained the most extreme speculative yen weakness, that rapid run-up past 160. They sent their message and forced a lot of speculative short positions to liquidate.
So they basically broke the momentum.
Exactly. But they also have structural support building beneath them now.
Right.
Because the Bank of Japan members are increasingly leaning toward raising rates. That hawkish shift we saw on April 28th, it provides a fundamental floor for the yen.
Got it.
It's no longer just artificial intervention holding the currency up. It's the growing expectation of higher Japanese interest rates. So 1 in 60 has essentially become the new psychological resistance ceiling.
That makes a lot of sense.
Furthermore, because the market has largely priced in the immediate risks of the Middle East conflicts, geopolitics won't actually be the primary driver this week.
Okay, so what will be?
The true driver of the yen will be upcoming U.S. economic data, which ultimately dictates what the Federal Reserve does next.
Right. And since U.S. data is in the driver's seat, we have to look really closely at the schedule. Which brings us to our third pillar, the weekly timetable.
The most dangerous part of the week.
Completely. The massive risk here is that Japanese institutional investors are essentially sitting ducks while global data fundamentally reshapes the market.
Yeah.
So let's tag team a detailed breakdown of what is hitting and when. Monday, May 4th. In Japan, it is Greenery Day. The market is closed.
Right?
Interestingly, the UK and China are also closed for holidays, making for a relatively quiet start globally.
Quiet, but we still see U.S. March factory orders. And on the earnings front, we get numbers from National Australia Bank, along with major U.S. tech and pharma names like Vertex and Palantir.
Palantir is a really critical one to watch, actually.
Oh, absolutely.
Because it isn't just a software company. It acts as a bellwether for enterprise AI spending. If they show a slowdown in corporate adoption, that infects global tech sentiment before Tokyo even opens its doors.
Precisely. And then we move to Tuesday, May 5th, Children's Day in Japan.
So the domestic market is still closed.
Still closed, but globally, the data drops are massive. The Reserve Bank of Australia holds their board meeting.
Okay.
And more importantly, the U.S. releases a huge wave of crucial economic indicators. We're talking the March trade balance, the April ISM non-manufacturing index, which measures the health of the services sector, and new home sales.
Right.
But the absolute standout on Tuesday is the JOLTS data.
Right. The job openings and labor turnover survey. I always look at this as the leading indicator for inflation.
Exactly. The mechanics of JOLTS are central to the Fed's strategy. It basically tells us how tight the U.S. labor market is. If there are millions more job openings than unemployed people, employers have to compete for talent.
By raising wages.
Exactly, by raising wages. And wage inflation is incredibly sticky. If wages are driving up prices, the Federal Reserve simply cannot cut interest rates.
And if those rates stay high, the dollar stays strong against the yen.
You got it.
And while all that macro data is dropping, Tuesday also features earnings from global heavyweights like Ferrari, AMD, Pfizer, and Shopify.
That's a huge lineup.
It is. If AMD provides soft guidance regarding chip demand, or if the JOLTS data shows a surprisingly hot labor market, Tuesday is the exact day we will see that USD/JPY 155 to 160 range aggressively tested.
And all while Tokyo traders are out for Children's Day.
Sitting on the sidelines.
Right. Moving to Wednesday, May 6th. It's a substitute holiday in Japan, so the doors remain closed.
Yep.
The U.S. drops the April ADP employment report, which gives us private sector payroll data as a sort of sneak peek before the official government jobs report.
And the earnings slate on Wednesday is just as heavy. We have Walt Disney and Uber providing a really good cross-section of consumer health and gig economy dynamics.
Right.
But the ones that really stand out for the Japanese market are ARM Holdings and Infineon.
Infineon is particularly vital. It acts as the canary in the coal mine for global industrial and automotive semiconductor demand.
Okay, so if they flag slowing industrial orders,
That directly dictates the harsh environment Japanese manufacturing heavyweights will wake up to on Thursday.
which brings us to Thursday, May 7th. The Japanese market finally wakes up. Traders are back at their desks, and they're going to have a mountain of delayed reactions to process.
A literal mountain.
Domestically, we see the April monetary base and Tokyo office vacancy rates.
And Tokyo office vacancy rates are an excellent barometer for domestic corporate expansion and the health of the real estate sector in a rising interest rate environment.
Oh, that makes sense.
We also see the release of the Bank of Japan's March meeting minutes on Thursday. The market will heavily scrutinize those minutes for any further hints about the timing of the next rate hike.
Just looking to reinforce that fundamental floor for the yen we talked about.
Exactly.
We also get domestic earnings from Ajinomoto and Yokogawa Electric. Meanwhile, the U.S. releases consumer credit data, with earnings rolling in from Shell and McDonald's.
Right.
But looking at the broader timetable, Thursday really just serves as the warm-up for Friday, May 8th.
Yeah.
Because Friday is a structural bottleneck of epic proportions.
It truly, truly is. First, as we discussed earlier, it is options SQ day in Japan.
Right.
So the mechanical volatility of unwinding derivative positions is already dialing up the pressure. We also get the March monthly labor survey in Japan. But the domestic earnings lineup is what's staggering.
Oh, it's unbelievable. We are talking about Toyota, Sony Group, NTT, JT, Nintendo IHI, and Line Yahoo all reporting on the exact same day.
It's just a huge wave.
You have the world's biggest automaker, major entertainment conglomerates, heavy industry, and telecom all dropping their numbers simultaneously.
It's like trying to push a week's worth of water through a garden hose. You have this massive influx of top-tier domestic earnings hitting a market that is already being forcibly recalibrated by options SQ volume.
Right.
All while investors are still digesting the Tuesday and Wednesday U.S. macro data.
And just when Japanese traders might think they can breathe a sigh of relief as the Tokyo session closes on Friday, the ultimate global market mover drops late Friday night, Japan time.
The big one, the U.S. April employment report, the official non-farm payrolls.
Yeah.
This is followed closely by the Michigan Consumer Sentiment Index. The jobs report is the single most important data point for the Federal Reserve.
Hands down.
It will definitively dictate the trajectory of U.S. interest rates and, therefore, the trajectory of the dollar against the yen for the next month.
Now, before we wrap up the schedule, you wanted to highlight an important asterisk regarding the U.S. data releases.
Oh, yes. Thank you. The source material explicitly notes that U.S. economic indicators might face unexpected delays in their release times this week.
Oh, really? Why is that?
It's due to the lingering administrative effects of a U.S. government shutdown. So if you're sitting at your terminal waiting for a crucial data drop at a specific minute and it doesn't appear, you need to factor in bureaucratic friction before assuming it's a trading platform error.
That is a vital piece of context. So wow, we have covered a lot of ground. We've explored the structural resilience of Japanese stocks against the mechanics of the options expiry trap.
Right.
We've mapped the yield differentials driving the whiplash of the yen and the severe flash crash risks of a thin holiday market. And we've unpacked a week where the global economy drops massive, fundamental data points, while Japanese institutional capital is mostly on holiday.
It basically requires navigating a minefield of liquidity risks and delayed reactions.
It really does. Which leaves me with a final provocative thought for you listening to mull over as we head into this unprecedented schedule. We talked about the Nikkei acting as a heavy-duty shock absorber, but with so much fundamental global data hitting an illiquid market, from AI bellwethers like Palantir and ARM to the critical U.S. labor metrics, will the explosive bottleneck of Thursday and Friday fundamentally reset the market's baseline for the entire summer?
It's a great question.
When everyone finally returns to their trading desks, having to price in 5 days of global market moves in a matter of hours on an options CQ day, will those shock absorbers finally break under the sheer mechanical pressure? It is definitely something to watch very closely.
Absolutely.
Thank you for watching the Japanese Economic Review. We look forward to having you with us again.